Wednesday, June 10th, 2009. Larry Fink has barely slept. Somewhere across the Atlantic, a $13.5 billion deal is being finalized. One that will change the architecture of global finance forever. His team is ready. The lawyers are ready. The press announcement is drafted and waiting. But at the 11th hour, the $2.8 billion funding package collapses. The commitment letters are rejected. The money isn't coming. With the clock ticking down, Fink has less than 24 hours to find billions in cold, hard cash, or watch the deal of a lifetime vaporize. To understand what was at stake that Tuesday night, you have to understand the world it happened in. It's 2009, 1 year after the worst financial crisis since the Great Depression. Lehman Brothers has collapsed. Bear Stearns has vanished. The American housing market, the bedrock of the global financial system, has turned out to be built on a foundation of lies, greed, and financial instruments so complex that the people selling them barely understood what they were. Banks that once seemed like permanent fixtures of civilization are standing at the edge. Some have already fallen. In London, Barclays Bank is in trouble. To avoid a UK government bailout, which would have come with restrictions, public scrutiny, and the humiliation of state control. They need to raise capital, urgently, quietly. Their solution is to sell the most valuable thing they own, Barclays Global Investors, BGI, a name almost no one outside of Wall Street knows. But inside those walls, it is spoken of as the crown jewels. Barclays Global Investors, BGI, isn't just a fund. It is the future of investing. Already built, already working, waiting for someone smart enough to see it. At its core is iShares, a product so elegantly simple that it would eventually change how hundreds of millions of ordinary people around the world invest their money. Before iShares, owning 500 different stocks meant buying a mutual fund. Slow, expensive, difficult to exit. BGI had taken those 500 stocks and wrapped them into a single ticker on the stock exchange. Think of it as the difference between downloading 500 songs one by one and pressing play on a single playlist. One click, one price. Everything you need in a single trade. In 2009, most of Wall Street still thinks of ETFs as a niche product, a clever experiment for specialists. Larry Fink sees something else entirely. He sees the future of the stock market sitting inside a bank that desperately needs cash. Barclays has already found a buyer. A private equity firm called CVC Capital Partners has agreed to purchase iShares alone for $4.4 billion. The deal is essentially closed, but the contract contains one clause, a go-shop clause, giving Barclays 45 days to consider a better offer if one arrives. Fink moves immediately. He doesn't want just iShares. He wants the entire BGI empire, the infrastructure, the talent, the global reach, the data. He sees in it the single missing piece that transforms BlackRock from a powerful firm into the permanent number one. His offer? $13.5 billion for everything. Nearly triple what CVC was paying for just the ETF arm. BlackRock will pay $6.6 billion in cash and hand Barclays 37.8 million shares of BlackRock stock. CVC is pushed aside with a $175 million breakup fee, a consolation prize for a deal that was never really theirs to win. There is one problem. Fink is $2.8 billion short. One of the most legendary behind-the-scenes details of this entire deal is what happened next. To close the gap, Fink needed $2.8 billion in outside equity. And the person who came to him with a solution was Amanda Stavely, head of PCP Capital Partners, and at that moment, the most talked-about dealmaker in London. She had just pulled off the impossible, brokering a £7 billion lifeline from Sheikh Mansour of Abu Dhabi straight into Barclays itself, the deal that kept the bank out of government hands in the first place. If anyone could move billions quietly and fast, it was her. She offered to do it again, this time for BlackRock. Her team delivered the commitment letters. In high finance, a commitment letter is the ultimate proof of life, a legally binding contract proving the cash is real and will be there at closing. But when BlackRock and their advisors at Citigroup opened them, something didn't add up. The money wasn't coming directly from a transparent sovereign fund like Qatar or Abu Dhabi. It was routed through a special purpose vehicle, practically a shell company designed to shield the identity of the underlying investors. It was a black box. You don't know what's inside. And in this case, the SPV was controlled by Stavely's own firm. Nobody at BlackRock could say with certainty whose money was actually sitting inside it. For Fink, this wasn't a technicality. It struck at the foundation of everything BlackRock had built its reputation on. If the shell company didn't have the cash on closing day, there was no one to hold accountable. There's no point in suing a shell company. Nothing to collect. And if BlackRock couldn't verify its own investors, it violated the most basic rule in finance. Know your customer. There's a lot of dirty money in the world, and BlackRock wants nothing to do with it. That's not caution, that's risk management. Then there was Fink's red line. No middlemen. He wanted to look the people who actually owned the money in the eye, not negotiate with a gatekeeper standing in front of it. So, just hours before the biggest deal of his life was set to go public, he walked away. What follows is one of the most intense fundraising sprints in the history of Wall Street. With the original financing gone, BlackRock has to assemble an entirely new group of investors. The clock is ticking. The firm turns to relationships it has spent decades building. No middlemen, just direct calls to the people who actually control the capital. Singapore's GIC commits directly. China's CIC steps up right behind them. Kuwait's investment authority delivers its guarantee with no conditions attached. And BlackRock's largest existing shareholder, PNC Financial Services, anchors the round. 4 of the most powerful pools of capital on Earth, assembled in under 24 hours. Together, they provide the roughly $2.8 billion in equity BlackRock needs to move forward. On June 11, 2009, the acquisition is announced. BlackRock agrees to buy Barclays Global Investors for $13.5 billion, creating the world's largest asset manager. At announcement, the combined firm is expected to oversee more than $2.7 trillion in assets. By the time the acquisition closes later that year, that figure has grown to roughly $3.2 trillion. Everyone focuses on that multi-billion-dollar price tag. Almost nobody talks about what Fink actually walked away with. The best way to understand why this deal was a bargain is just to look at the scale of what it became. Today, iShares alone commands $5 trillion, more than the entire economies of Spain and Italy combined. And the global ecosystem it anchors pushes past 20 trillion. That is roughly the size of the entire economy of China. As part of the payment, Barclays took a 19.9% economic stake in BlackRock. Because of that, BlackRock's surging stock price pushed the transaction from its initial $13.5 billion announcement to a staggering $15.2 billion by the time the assets actually transferred 6 months later. When new international regulations later forced them to liquidate it, the massive cash injection and regulatory relief unshackled their balance sheet for a generation. Both sides won, but only one side won everything. The BGI deal didn't just make BlackRock the biggest, it gave them iShares, which rewired how the entire world invests. It gave them sovereign relationships that span the globe. And it revealed something about Larry Fink that Wall Street would never forget. Under maximum pressure, with billions missing and hours on the clock, he doesn't panic. He cuts out the uncertainty, calls the right people, and closes the deal cleaner than it was before the crisis hit. The world belongs to those who profit from other people's money. On the morning of June 11, 2009, Larry Fink became the undisputed master of the financial world. And this was just the beginning.